Welcome to today's deep dive into one of the most important financial decisions homeowners will make in 2026, HELOCs, home equity loans, and cash-out refinances. Whether you're looking to access equity in your home to fund a renovation, pay off debt, or cover other major expenses, it's essential to understand the differences between these three popular options. Let's start with HELOCs. Home Equity Line of Credit, or HELOC, is essentially a revolving credit line that allows you to borrow against the equity in your home. Think of it like a credit card, but with much lower interest rates. You're given a maximum credit limit, and you can draw funds as needed, paying only on the amount you borrow. This makes HELOCs incredibly flexible, especially if your financing needs are unpredictable or ongoing. But what makes them attractive in 2026? Well, the low interest rates continue to make them a popular choice, especially for homeowners with good credit. However, it's important to note that HELOCs typically have a variable interest rate, which means that your payments could rise if interest rates increase. So, if you're planning to borrow a substantial amount for a longer period, you'll need to consider the potential risks of a rate hike. Next up, home equity loans. Home equity loans differ from HELOCs because they offer a lump sum payment upfront with fixed terms and fixed interest rates. This means your monthly payment remains predictable throughout the life of the loan, which provides security and stability. Home equity loans are ideal if you need a specific amount of money for a one-time expense like paying for college tuition or completing a home improvement project. In 2026, home equity loans are particularly attractive for those who prefer the certainty of fixed rates, especially in an environment where interest rates could fluctuate. However, they do have some downsides. Unlike HELOCs, you cannot borrow more money after the initial lump sum, and the repayment period is usually shorter than a mortgage, making the monthly payments higher. Now, let's talk about cash-out refinances. A cash-out refinance replaces your existing mortgage with a new one that's larger than the current loan balance. The difference between the new mortgage and the old one is paid to you in cash. This option is a solid choice if you have significant equity built up in your home and need a large amount of cash for a major expense, such as home renovations or consolidating high-interest debt. In 2026, cash-out refinances remain a popular choice for those who want to lock in a fixed interest rate and have a large chunk of equity to tap into. However, they come with some important trade-offs. By refinancing your mortgage, you're essentially restarting your loan, potentially extending your loan term, and possibly paying more interest over the long run. It's also important to consider closing costs, which can add up. So, which one saves you more in 2026? Well, the answer really depends on your financial situation and goals. If you prefer flexibility and the ability to borrow and repay multiple times, a HELOC might be the best choice. If you need a fixed, predictable loan amount and repayment structure, a home equity loan could be your solution. And if you're sitting on a significant amount of equity and need a larger sum of cash, with the advantage of refinancing your entire mortgage, a cash-out refi might be the best option. Before you make your decision, it's essential to consider factors like your credit score, your income, your debt-to-income ratio, and the potential for interest rate changes in 2026. It's also wise to speak with a financial advisor to determine which option fits best with your long-term goals. No matter which path you choose, remember that tapping into your home's equity is a big decision. It's important to do your research, weigh all your options, and make sure you're choosing the one that will save you the most money over time. On the other hand, a home equity loan gives you certainty. By securing a fixed interest rate and a set repayment period, you can plan your finances with confidence. This option is ideal for those who are looking to make one-time, significant purchases or investments, such as home renovations or paying off high-interest debt. The fixed rate guarantees that your monthly payment won't change, even if interest rates in the broader economy fluctuate. This is particularly attractive if you want stability and want to avoid any surprises down the road. Cash-out refinances provide a larger lump sum upfront, which can be incredibly helpful if you need a substantial amount of money for large projects or major life events. By refinancing your mortgage, you can access more equity in your home and potentially get a better interest rate than you currently have on your existing mortgage. However, while this option can seem appealing, it's important to remember that you'll be restarting your mortgage, potentially extending your repayment period and possibly increasing your overall interest costs. In addition, cash-out refinancing often comes with closing costs, which can be significant. For some homeowners, the combination of a higher loan balance, extended repayment term, and added fees may make this option less desirable. There's also the question of whether refinancing or taking out a new loan might affect your overall debt picture. In some cases, refinancing your mortgage with a larger loan can lead to a higher monthly payment, especially if you are extending your term or rolling other debts into the loan. You should carefully consider whether this will fit within your budget and what impact it could have on your financial goals. Additionally, it's important to understand the long-term costs involved with each option. While HELOC may have lower initial costs and more flexible terms, the potential for rising interest rates makes it less predictable over the long term. In contrast, home equity loans offer a more stable option but at the cost of being less flexible. Cash-out refinances may give you more money up front, but they often come with more complex terms and higher fees, and you'll be adding to your mortgage debt, which can affect your financial flexibility. In terms of tax implications, homeowners should also be aware that the interest paid on home equity loans and HELOCs may be tax deductible if the funds are used for certain purposes, like home improvements. However, the rules around this can change, especially as tax laws evolve, so it's important to stay up to date with the latest regulations or consult with a tax professional before making a decision. As we look ahead to 2026, the overall economic environment will play a big role in determining which of these options is the most beneficial. If inflation rates are high and interest rates continue to climb, locking in a fixed rate with a home equity loan or a cash-out refinance could help homeowners avoid the risk of rising costs. On the other hand, if rates are stable or falling, a HELOC could be the right choice for those who want flexibility and the option to borrow more in the future without committing to a long-term loan. Ultimately, no one-size-fits-all solution exists when it comes to leveraging the equity in your home. The right option will depend on your specific financial situation, your goals,